Arrive before the market opens. The trading floor is already awake. Screens flicker across the room. Market data scrolls faster than you can read it. Futures, options, currencies, and bonds. Prices moving every second. You sit down at a desk that isn't really yours yet. 6 monitors, a headset, a terminal filled with charts you barely understand. You are not here to trade. Not yet. Your job is observation. You update spreadsheets, track positions, record the desk's daily profit and loss. When a senior trader shouts an order, you log it immediately. Every movement on the floor has a rhythm. Conversations about liquidity, spreads, volatility. Half the language sounds like another dialect of finance you're still learning to speak. You studied markets for years before this job, but this is different. Because here, every number on the screen represents real capital. And for the first time, you realize something about trading. The market is not theory. It is a machine that moves money in real time. You start touching the keyboard, not often, not with a large size, but enough that the desk notices when you make a mistake. Your role shifts from watching to execution. A senior trader calls out an order. You route it through the system. Equities, options, futures. The positions are small compared to the desk's total exposure, but they are large enough to matter to you. A $30,000 loss flashes on the screen one afternoon. It disappears within minutes when the senior trader closes the position. No one panics. No one raises their voice. But the lesson lands immediately. Losses are normal. Uncontrolled losses are not. You begin tracking something new. Risk limits, maximum position size, maximum daily loss, maximum exposure to volatility. Trading, you realize, is not about predicting markets. It is about controlling damage when predictions are wrong. At this level, you don't make strategies, you follow them. And slowly, the desk starts trusting you with something more dangerous. A position of your own. Your name appears on the desk's risk sheet, a small trading book. Limited capital, strict boundaries, but the positions are yours. Each morning begins with the same ritual. You scan overnight markets, check futures, read headlines that might move prices before the opening bell. By 9:30, the floor becomes louder. Orders move faster. Your screens fill with numbers that now directly affect your P&L. The first profitable week feels like validation. The first losing week feels much heavier. A single position moving the wrong direction can erase days of gains. Every decision carries consequences measured instantly in dollars. You begin noticing patterns in the market, not just in price charts, but in behavior. Liquidity appearing before news, volume increasing near certain levels, large orders moving quietly through the system. Trading stops feeling random. You are no longer observing the machine. You are inside it now, and the next challenge is learning how to stay there. Your trading limits increase. The desk allocates you a larger book, more capital, more responsibility. Your positions now move in sizes large enough that execution matters almost as much as the trade itself. You stop thinking only about direction. You think about liquidity, where the buyers are hiding, where the sellers will panic, how much size the market can absorb without moving against you. Your screen no longer shows just price charts. It shows order flow, depth, spreads across multiple exchanges. Some days the market feels predictable. Other days it moves violently with no explanation. Consistency becomes the real objective. One strong month is meaningless. What matters is producing profits month after month, without a catastrophic loss that forces risk managers to cut your limits. You start understanding something senior traders already know. Markets are not driven only by information. They are driven by capital moving through the system, and the larger your book becomes, the more you feel that flow. Your screen layout changes. Fewer charts, more dashboards. Risk metrics begin to matter more than individual trades. Exposure across sectors, correlations between positions, volatility spikes that can wipe out gains if you're positioned incorrectly. Your capital allocation increases again. What used to be a large position is now just one line inside a much larger book. Tens of millions moving across equities, derivatives, or macro positions depending on the desk you sit on. But the real shift is not size. It is responsibility. You are no longer only managing your own trades. Junior traders come to your desk with ideas. They ask how much size they can run. They ask how to manage a position when the market moves against them. You recognize the same uncertainty you once had. The difference is that your decisions now affect multiple books, not just your own. Risk managers start calling you directly when markets become unstable. Your desk's exposure appears in the daily firm report. A bad decision at this level doesn't just lose money. It affects the desk's reputation. You start thinking differently about markets, not just about whether a trade will work, but whether the risk profile of the desk can survive if it doesn't. Because trading at this level is no longer about winning individual positions. It is about protecting capital through entire market cycles. And once your performance becomes consistent enough, the firm gives you something even more dangerous: control over how capital is deployed across the desk itself. Your job is no longer trading, it is allocation. The firm gives you control over a portfolio large enough that no single position defines the outcome. Instead of focusing on one market, you manage exposure across multiple strategies: equities, macro trades, option structures, relative value positions. Your responsibility is deciding where the capital goes. Some of it flows to traders on your desk. Some moves into systematic strategies built by quant teams. Some remains in reserve, waiting for volatility that creates opportunity. Your screen still shows markets, but the time horizon changes. You are no longer thinking in hours or days. You think in quarters. Investors now care about your numbers. Hedge funds, pension allocations, institutional capital, they all measure performance through consistent returns and controlled drawdowns. A strong year attracts more capital. A weak year invites questions. Meetings begin replacing some of your time on the desk. Risk committees, investor updates, discussions about how to position the portfolio if interest rates shift or liquidity disappears from the market. You are still connected to trading, but the role is different. You are designing the structure of the portfolio, not executing every move inside it. At this level, the real skill becomes understanding how different risks interact. One strategy offsets another. One market hedges the exposure of another. Because when the portfolio grows large enough, a new realization appears. Your capital no longer just participates in markets. It begins to influence them. Your desk disappears. The trading floor is no longer the center of your work. The noise, the shouting, the constant stream of orders, that world now runs through teams that report to you. You run a fund. Capital arrives from institutions that measure their investments in billions. Pension funds, endowments, sovereign wealth vehicles allocating money across the global financial system. Your responsibility is no longer a single portfolio. It is the entire strategy of the fund. You decide how much exposure goes into equities versus macro trades, how much capital moves into derivatives designed to hedge volatility, which traders receive larger allocations because their strategies have proven resilient. When the fund opens a large position, execution becomes a process that unfolds across multiple markets. Orders are divided, liquidity is monitored, counterparties are chosen carefully, because trades at this scale do not simply pass through markets, they move them. A large shift in your portfolio can ripple through futures markets, options pricing, and currency pairs before the position is fully established. Your role now involves more than trading. You meet investors who want explanations, risk committees that review exposure, advisors who study how the fund's strategies align with broader market conditions. Performance is still measured in returns, but reputation becomes just as important, because at this level, capital flows toward people who have proven they can protect it, and the larger those flows become, the closer you move to a different layer of the system, one where trading itself is no longer the main function. The screens matter less now. Markets still move every second, but you no longer need to watch every tick. Entire teams handle execution, traders monitor volatility, analysts track positioning across asset classes. Your role sits above the activity. You allocate capital across systems. Billions move through structures connected to your decisions. Hedge funds, private investment vehicles, partnerships with institutional investors that deploy capital across multiple markets at once. Conversations at this level rarely focus on individual trades. They focus on capital flows. Which markets are attracting liquidity? Which sectors are becoming crowded? Which currencies or bonds are beginning to show stress beneath the surface? A position built at this scale can take weeks to establish. Orders are spread across exchanges, counterparties, and time zones, so the market never sees the full size at once. Because when capital moves in billions, visibility becomes risk. You begin noticing something else. Markets do not only respond to information, they respond to capital positioning. When large funds move together, prices adjust before the news ever reaches the public. At this level, trading becomes something quieter. You are no longer reacting to markets. You're helping determine where liquidity appears and where it disappears. And somewhere below, on a crowded trading floor, a new trainee logs into a terminal for the first time. He believes trading is about making money. Eventually, he will learn it is about position inside the machine that moves capital. You arrive